Welcome to Tradiers, the Trader's Edge podcast. I'm Jim Uriel. That's Bob Iacchino. Today's a little unusual. We're recording the show. We're coming to you on Monday. What's the date, Bob? The 19th?
19th, President's Day.
President's Day. And the show will air on Wednesday, the 21st. Bobby, Friday, this is the last stock market we saw. Markets were closed today. Did not fare very well. Closed on its heels. Big deal to you yet or no?
Not yet. I mean, it feels more like, and you see a lot of this chatter, right, where it's more like a healthy pullback.
Yeah.
I just think there's a lot of things starting to pile up. I hate, somebody called me a perma bear the other day. And I said, how can I possibly be a perma bear when I'm long stocks?
Yeah,
right? I consider myself risk conscious. So I guess I'm constantly searching for, little tiny, slightly off white swans that could turn black. And that's kind of the way I look at it. It's like, of course, I'm talking about things that could happen while I'm long stocks, as opposed to other people who talk about why everybody should be long while they're long stocks. That feels disingenuous to me.
So the thing with the longs, and I'm still long as well, because I decided a couple months back that as long as they were giving away options, there's no reason to not stay mostly long the stock market, putting in options protections. Every big up day, I've put on different options. Yes, it's expensive, but a good night's sleep is worth a lot of money too, right?
Yeah, I mean, I think that's kind of the best way to look at it. Again, if you're talking about what could or couldn't happen, you've mentioned this in a couple of shows that insurance has gotten pretty cheap. And it seemed to you, I believe these are your words, it seemed to you that when insurance is cheap is the time you should buy it, not when it's expensive.
Sounds good.
So, yeah,
I'm not sure I said that specifically, but it sounds kind of smart, so I'll claim it.
It's all yours.
So we have today's show. We're going to bring him in right now. Let's bring him in right now. I'll introduce him when he comes in. We have Gary Haubold, who is a Rice engineer, a Wharton MBA, and all-around smart guy. You guys may know him. He's very active on Twitter, always provides excellent insight, furthers the discussion in many ways. I'm so glad to have you. I'm glad for all the interactions we've had over the years, Gary. Thank you for that.
Thanks very much for having me on. I'm glad to be here.
Good. So there's a couple things that I want to hit on. First of all, it's going to be market related. Okay.
Sure.
Let's talk about leadership of the market, because I noticed you posted something about Apple. Was that maybe today or yesterday? Potentially rolling over. When you look at those names that have been doing the heavy lifting, the concept in general that everything is so top heavy, and the potential that those are particularly stretched, what worries you the most about that scenario?
Well, it's not a good sign for the market when you only have a very narrow number of stocks that are going up. Even if you look at like the Russell 2000 super microcomputer has been a big driver of the Russell 2000 return year to date. Even though it's only about 1% of the index, it's gone up so much. And the rest of the Russell 2000 stocks, the other 1,999, have been so lethargic that it's all been super microcomputer. It was the Magnificent Seven that was driving the returns. And then I think Tesla lost its crown or fell off of its throne. And then now Apple, the quarter they reported wasn't very good. Revenues were soft. And I don't think that their goggle product is doing very well, the virtual reality goggles. And on top of that, I believe if I read correctly, on Friday, Apple closed below its 200-day moving average, which is something technicians look at. I'm not a technician, but I do pay attention at where stocks close and where the moving averages are, and that's probably not a good sign.
Gary, when you talk about the magnificent, look at him, I can't even speak.
By the way, you joked on that same word like 10 times in the last 3 podcasts.
Yeah, I don't understand what's going on. I feel like I'm having tiny little strokes every 15 minutes where I can't speak anymore. But you mentioned the Magnificent Seven, and you mentioned Tesla, and then you mentioned Apple. And I'm curious, because I said this to somebody else, or somebody asked me about the Magnificent Seven, and my comment was, I think the Magnificent Seven won't be seven much longer. So my question to you is, does it shrink down at some point to the Magnificent Five, then the Magnificent Three, then the Magnificent One? Or are you the kind of person thinking, no, you just replace the two that have fallen off with another two or another four? I mean, if technology is the engine of productivity basically permanently, will there always be a Magnificent Seven, or does the market need better health metrics for that to be a thing?
My best guess is the market needs better health metrics, and that it's gradually going to winnow away. And it's not going to be based as much on general market action as it is individual stocks. Tesla's results haven't been good, and so I think Tesla has exited the Magnificent Seven and given us the Sexy Six, or whatever you want to call it. And at the moment, Apple is not looking very vibrant either. So I think before very long, we're going to be down from 6 to 5 as Apple leaves the fold. Maybe some other stocks will get added in, maybe not. We'll have to see. I mean, as you point out, technology is a big growth engine for the economy. The other thing I'd throw out there that we talked about it a lot back in the internet bubble days, but not so much anymore. But network effects are real, and most of these Magnificent Seven stocks, certainly Microsoft and Google and Amazon, they have network effects. They're almost quasi monopolies, if you will, and they're unregulated for the most part, and that's a huge advantage because the marginal costs are very low, and the diseconomies of scale don't operate in the digital realm the same way they do in the analog realm. And so with almost negligible diseconomies of scale, it's incredibly profitable to add new customers and grow units. And I think that's a big part of what we've seen with the Magnificent Seven, one way or another.
So I want to point out, because yes, Apple did close on Friday below its 200-day. Just pulled that up. And as we're talking, I went and looked at the last 3 times that happened. So it happened in October 26th of 2023, and Apple recovered in basically 3 additional sessions. Happened again February 24th of 2023, fell 2% before it then recovered. And then the time before that, and guess when that was? Approximately.
It's going to be the tech bubble burst, right?
No, August 2022. And
Oh.
Apple fell a total of 21.3% before it had any sort of meaningful recovery.
Yeah.
So this could mean a lot, right? Obviously, that's not a proper back test. That's pretty much curve fitting. But it is definitely something to pay attention to, because you could be down 2%, you could be down 20%, or you could recover in the next 3 or 4 sessions. And I think Gary's kind of pointing to that when he talks about that the market needs better health metrics. Jimmy, it's to you.
The other thing I'd point out on Apple, and it's not a huge deal, but I think it's meaningful at the margin, is that in those past episodes, Warren Buffett was either buying Apple or he was a holder of Apple. And in the 13F filing that we just got for the 4th quarter, Warren Buffett was a seller of Apple stock. It was only about 1% of his holding, if I did the math right. But it's still something. And you don't know how much Apple stock he sold in the 1st quarter of the year. That was the 4th calendar quarter we're talking about.
I wanted to point something else out real quick and wonder if you guys had heard any of this. I'm looking for the actual tweet. I can't even remember who put it up, but somebody put up a tweet. I think it was Larry McDonald. Okay, we all know who Larry is, right?
Absolutely.
Convert Bond is his Twitter, and he's got the Bear Traps report. He posted this metric, which I'll show you guys, but then I'll read it. Okay, this is his tweet. All right, you can't see it on here, right? But basically, on February 15th, Jeff Bezos sold 11 million shares of Amazon, $2 billion he received from that. The 13th, he sold 11.9 million shares of Amazon. And then on the 9th, he sold again 11.9 million shares of Amazon, 2 million each time. Have either one of you guys heard anything about that? It seems because it's 11 million shares each time, and they're like 2 weeks apart, it could be sort of pre-planned program sales. Still a lot of shares for the old founder to be selling, isn't it?
Yeah, but can I take that one or no?
Yeah, please.
I'm asking. What kind of idiot? And I know these guys who build their companies like to keep their wealth in their company. Part of it is a badge of honor. But from a financial standpoint, what kind of an idiot wouldn't sell? That's why,
some, right?
Yeah, you'd have to sell some. That's why we've all been taught from business school forever is insider buying is a big deal. Insider selling is not, because there's a multitude of reasons why insiders could sell. Gary, do you agree with that or no?
I agree with that 100%.
Yeah. So,
and
yes,
obviously in Bezos' case, he's got some odd things going on in his personal life. You never know what might be going on there.
But what about, like, why, if you were a billionaire, why would you be dating the woman with all the plastic surgery too? Bobby, do you have an answer to that or no?
It's a way of dating a young woman without actually dating a young woman and being creepy.
And I rarely try to ever make fun of someone's looks, but I do get frustrated when beautiful women start injecting things in their faces and they don't look beautiful anymore. Gary, do you have anything to add for Jeff Bezos' girlfriend?
I thought his original wife was more attractive than his new girlfriend, and I think he made a mistake that he's going to live to regret.
I actually agree with you 100%. And she seems nice. I talked to my wife about potentially pursuing Mackenzie Bezos after she got divorced. My wife gave me the green light on that, and there was 50 billion reasons why that was okay. But yeah. So anyway, I think we should get back to markets a little bit too. We've talked about the Magnificent Seven, or the Sexy Six now that we're calling them too. And you talked about individual stock picking. I still contend that the most important thing is the Fed. The most important thing is the cost of money. And I understand fully that the cost of money was high over the last couple of years, and the stocks ended up doing not so bad. So I'm rethinking my thesis, which is what you should do with thesis all the time. But I still think part of it was the belief that the Fed is going to ease, or at least the Fed is at the ready to ease if stress occurs. Do you have thoughts on that?
I think the Fed is definitely ready to ease if stress occurs. And I think that's actually part of what happened in the fourth quarter as the Fed pivoted, or whatever you want to call it, from basically being on hold to starting to communicate their willingness to ease and when it might or might not be appropriate to ease based on the data that comes in. You almost wonder if they're not seeing something from the regulatory front that's giving them pause underneath the surface. That would be one explanation for why they pivoted when they did. There's other explanations that are equally possible. I think that I try not to be political at all, because it makes making investment decisions easier. But I don't think there's any question but that the Washington establishment favors Biden over Trump. And the Fed is definitely part of the Washington establishment. So I don't know how it has to color their thinking a little bit. The fact that an easier monetary policy at the margin is going to be better for the incumbent candidate and not good for the challenging candidate.
And the fact that Donald Trump has made it plainly clear that his intention, which, by the way, I think Donald Trump just says things, by the way, without thinking through, but his intention is to fire Jay Powell. I mean, how could that not color Jay Powell's lens of how he looks at things? I think to suggest that there's no politics involved in that is the most unreasonable. That's more of a conspiracy theorist than saying they are political. Bobby, what do you got?
I got a question about this, because here's what I'm trying to understand myself. Is there a case, and I'm going to read something to you guys real quick, because maybe I found it. I don't know. Is there a case for the Fed to retain credibility as an independent, non-political entity and still cut rates? And here's what I mean. They said they need slack in the labor market, right? And while we're not seeing it in the data, and Gary, you're a Wharton MBA, so you can correct me if I'm wrong on that. I don't see it in the data, but what we are seeing is layoffs at Nike, Cisco Systems, DocuSign, Estee Lauder, Instacart, Morgan Stanley, Paramount, Warner Music, Zoom, Alphabet, Amazon, BlackRock, Citigroup, Discord, Duolingo, eBay, iRobot, Macy's, Microsoft, PayPal, Salesforce, UPS.
Gary, you're going to tell them we get the point at any time?
Yeah, I just think I'm obviously reading that list.
I thought you had it memorized.
I couldn't even say that other word a second ago. I was not going to try and say it again, but I'm obviously reading that list. So are they actually able to say, well, It hasn't bled into the system yet, Gary, but we are seeing slack in the labor force. Is that justifiable, or are they just going to lose credibility when they cut?
I don't necessarily think they're going to lose credibility when they cut, but they're walking a fine line for sure. And I mean, I actually, to me, and it's just my mind, it's not the world's mind, they lost some credibility when they did the pivot in the fourth quarter, because there's nothing in the data that really suggests that they should be talking about easing that changed in the fourth quarter, as far as I could tell. It was basically, well, inflation's coming down and it's looking pretty good. It's not anywhere close to 2% on the official numbers, but they started talking about easing. Aside from that, even with very low unemployment, initial unemployment claims and continuing unemployment claims are very low. I mean, everywhere you look, the things that supposedly make the Fed data dependent, the data that they look on and favor the most, I didn't really see the weakness that would have allowed for the pivot that they did in the fourth quarter myself. But the world took it fine, and that's what matters. It's how the consensus views it.
So my quick question, and by the way, when you see hand signals between Bobby and I, that's for Bobby. You talk as long as you want. The people are tuning in to hear you. I just wanted him to know we're old floor traders, so we're always talking with our hands back and forth. Oh shit! I just gave that. I think I forgot what I was going to say. I had something that was going to be earth shattering. I thought this is getting old thing.
Well, here I'll throw in that I left out Xerox and a couple of others. So, from the standpoint of this rate cut realm, to me it seems like, and I agree with your point that they lost a little credibility by pivoting so quickly, because they remind me of, if either one of you watch the NFL, you'll see a team dominate 3.5 quarters, and then they switch to what's called a prevent defense. And next thing you know, the team they're playing against is just ripping off yards and starting to make the game close. And that's what that pivot reminds me of. So scared to see the market go down, so scared to see the economy creep possibly into a slower growth mode, and they give up the game, which is inflation, in my opinion. Do you think the Fed's number one job is still inflation?
What I think their number one job is doesn't really matter, but
that's a good point.
I think that the Fed wants to convince the world that fighting inflation is their number one job, and that they see it as their number one job, but in reality it's not, because they're too worried about what happens if the global economy or the U.S. economy or the U.S. financial system goes sliding off the skids. And, we got a little taste of that in the first quarter last year with Silicon Valley Bank shares and Sovereign Bank and the other deposit outflow crises that led them to create a $100 billion program to stem the decline.
So can I add to that real quick? Because we saw, when you mentioned March of 2023, how lightning quick they opened the door to what I consider quantitative easing by buying bonds at par that weren't worth par. That I don't see how anyone can call it anything other than quantitative easing. But they came to that conclusion like in a day, like, oh, there's stress in the banking system, which leads me to my question, which is the one I forgot. Commercial real estate, potential problems in the banking system, a little bit of glimpse from New York Community Bank, which oddly is the bank that took over Signature Bank. So it really kind of brings the whole thing home. Why haven't we seen I'm going to ask both of you guys this, starting with you, Gary. Why haven't we seen the problems, what I thought were going to manifest themselves in the commercial real estate market and banks suffering and stress? We haven't seen that at this point in time, despite the fact that we read about how occupancy rates are just through the floor.
That's a really good question. And, Sir John Templeton said that the four most expensive words in the English language are "this time is different." And I'd actually suggest that the three most underused words in the English language in investing, at least, are "I don't know." and so, in my opinion, you ask a great question, and my honest answer is, I don't know. I thought it would have shown up already.
Me too. And do you ever notice, by the way, in the business world, anytime someone says, that's a really good question, what they're saying is I have no idea what the answer is, which I do it all the time too. So it's like a little handy dandy translator. Bobby, do you have any idea?
Well, first I'll throw in those three words got me my first death threat. I was on CNBC with Joe Kernan, And Joe said, yeah, I don't even remember what the situation was, but Joe said, so Bob, what do you think? And I said, Jesus, Joe, I don't know. And I came back from the studio, trading floor, Jimmy knows it, where we used to do these spots. And on my voicemail was, don't take the Lord's name in vain or watch your back because the Lord may shoot you with a handgun or something to that effect. But so those 3 words got me in trouble. I guess it wasn't those 3 words that got me in trouble.
That was the Jesus word. Yeah.
The commercial, and actually I'll turn my answer into a question for both of you. The commercial real estate market confuses me a little bit. I've been saying for a while that we're not even a full 12 months past the problems with SVB, right? And to me, that's not enough time to say that everything's okay. Just because the Fed, because not only did they rescue a bank or 2, but they also said, we'll decide if we're going to rescue you or not. Right, Jimmy, you and I have talked about that a couple of times in the past few weeks. So there could be problems coming up where Janet Yellen just says, look, I've decided you're not big enough to save. And I don't know how far that sort of hole goes. But from a perspective of slight different take on this, I've had a lot of people reach out to me. My buddy John DeSorga, who's in the business, a couple of other people have reached out to me and said, I think this Trump verdict in New York causes an acceleration of commercial real estate problems. Do either one of you have an opinion on it? I honestly can't really follow that logic, but it's something that Mr. Wonderful, Kevin O'Leary, has said publicly.
Can I just add a quick thing before you answer, Gary?
Yeah, please.
Is that just a quick one? Is that Governor Kathy Hochul came out in all her infinite wisdom and basically said, all you other developers have nothing to worry about. And if you'll take out your translator, we just translated what that's a good question means. That means if your name's not Trump, we probably aren't going to nail you to the cross like we've done before. So I think it has the potential, like what you're saying, Bobby, but that's why I think she came out in front of a microphone and said it. Like, don't worry, we're not changing anything up here. Gary, do you have any opinion on that?
Yeah, I mean, I don't want to defend Trump or any of the exaggerations that.
Yeah, we're talking about the verdict and the market implications.
Oh no,
we're not being political.
I'm coming right to that. I just throwing out that caveat because.
Yeah, please.
You're talking about death threats here, and when we get off the air, I don't want to get a phone call from.
It's a great point. It won't
happen for a couple of days because we're not live, but still, I don't want to death threats. In any event, I am in no way defending Trump with this, but I would think that don't all the real estate developers grossly exaggerate to the point of lying the value of their properties when they're trying to get loans? I mean, I don't want to impugn the integrity and honor of your average real estate developer, but I thought they were all wild-eyed optimists to begin with.
And that's the beauty of the system, I thought, is the animal spirits, the wild-eyed optimism, as you just said. That's what drives everything. And to value a personal asset, one, to think it's worth more than it is without having an actual market to ascertain the price. I mean, that seems perfectly reasonable to me. And then you look at their valuing of it of $25 million, or some even said they may have valued at $18 million. Well, that's absurd as well. There's a property a third the size in Palm Beach that's for sale right now for $250 million. So the whole thing, again, I don't even like Trump. The fact that the people who keep coming after him forced me into a position to defend him just because I'm really just defending the system is completely, it irritates the shit out of me. Anyone?
But my short answer would just be that I do think that Trump is so unique and what's happening to him legally is so unique that I don't think other people are going to worry that they're going to come after me next. And I almost think that the New York governor made things worse by raising the point.
Yep.
Wow,
now people are going to think, what? They could do that?
That's a great point.
I don't think anyone is thinking that they're going to get treated the way Trump's been treated.
The way things are now, it's almost laughable because the minute you say that this thing that's happening to Trump is not fair, if it was anyone else, it wouldn't be happening this way. You get labeled MAGA, Trump, cult member, crazy, which is ridiculous because it seems to people that they can't think about a situation or a policy outside of the personalities, which is part of the reason we do this show, Gary, to be honest. So I want to go back to markets if we could. You are a Wharton MBA, which matters to me, quite frankly, because it's a great school and you know some pretty famous people that we can talk about or don't talk about. What do you see, I was mentioning to Jimmy in the lead into the show that as someone who tries to be long stocks most of the time, I look for little off-white swan puppies. Are they called puppies?
Yeah, I think so.
Ducklings, chicks, whatever, that could turn into black swans. I'm always looking for those, and that's what I'm always talking about. So people say to me that I'm a perma bear, which I find laughable because I'm usually long, right? What, if anything, do you see on the horizon that an investor, medium or long term, should worry about? I assume that's your focus. You talk about time value investing a lot. So
Yeah.
what do you look for and you say, this worries me and these things don't?
Well, in terms of, Robert Malthus, going way back in time, his bright idea was that the population grows geometrically and the food supply grows arithmetically. And so that was going to lead to mass starvation and hell freezing over. And of course, he got that completely wrong. But what is true is that debt to GDP right now is 120%. And the government deficit is between 6 and 7% of GDP. And it's not shrinking. It's going sideways at around $1.6 to $1.7 trillion. And we have recessions. So over intermediate to longer time periods, GDP does not go straight up, but the compounding on the debt is relentless. So, I mean, you don't have to be a genius. Jamie Dimon of JP Morgan was just saying, I forget what he called it. It's like the most easily anticipated financial crisis in history or something like that. Things that can't continue forever don't. And we're going to hit the wall and we're going to have the financing crisis at some point in the next 2 or 3 years. We just don't know when it is. And I do think we got a very small taste of that in the third quarter of last year when the Treasury came out with their quarterly refinancing announcement on August the 1st. And the dollar shot up and interest rates spiked and the stock market rolled over hard. And it's going to happen again. We just don't know when.
So to put a finer point on that. So over the last 120 years, there's been 53 countries that have reached debt to GDP ratios of 130%. And we are within spitting distance of that. We are close enough to smell the perfume of that level. Of those 53 countries, 52 had some level of a default, whether it be hyperinflation, huge currency devaluation, or an actual default. The only one that didn't was Japan. You're saying, and I agree 100%, but just to put a finer point on it, what you're saying is that we have passed the point of no return because the amount of debt service we have to borrow to pay is already become such a huge boulder on our shoulders that there's no possible way to get out from under it. Is that what you're saying?
I think we're close to the point of return. I don't think we're past it. It's an election year, and there certainly doesn't seem to be any appetite for doing anything reasonable. But I do agree with you. And one of the really hard things when you think about this deeply and logically, and it certainly makes sense to look at past examples like the ones that you were just citing. That's probably from the Rogoff study, I would guess.
I think so.
But I don't think any of those 53 cases were the key currency that trade is denominated in.
It's an excellent point.
That's the point.
Yep. That does make us different.
Yeah.
We get to borrow in our own currency for now. It'll be interesting to see how all of that plays out going forward. And then as some smart people online who talk about milkshake theories of the dollar like to point out,
good old Brent.
He's our buddy.
There's we think about the U.S. debt as being large, and it is large. I mean, the numbers that I've seen and I use for sort of the net U.S. government debt is somewhere around 27 or 28 trillion dollars. And then if you do the gross debt, it's more, I think it just went over $34 trillion. Well, as Brent will tell you, if you look at Eurodollar debt, what's on the books is probably around 30 trillion. And if you do all the Eurodollar debt that's not on the books, plus what's on the books, you may have a number that's more like 50 trillion. And so that's this latent unrelenting demand for US dollars that's outside the US borders that hasn't been, I mean, that's a relatively new development. I think it's only in the last 20 or 25 years that we had this explosion in Eurodollar debt offshore to that magnitude.
So are we saying, as Brent's saying, is that yes, we've become profligate spenders, we become irresponsible with stewardship of our currency, but everyone else is that or even worse? That's the point of it, right?
And the point of it is it's denominated in dollars.
Yeah.
It's not just that you have the same sort of profligacy of the United States being repeated in other developed countries. It's not the countries as much. It's businesses, but it is countries as well who are borrowing in dollars, and they shouldn't be. It doesn't make any sense to me why people are so eager to loan to third world countries in dollars, because it's just that much harder to pay back. And when you get a currency crisis, then they can't pay you back because they don't have the dollars and they can't find the dollars.
Right.
So how do you prepare clients for that? I mean, well, let me actually go in a different direction. Time value investing is something you spend a lot of time talking about and working on. Explain what that is to people.
What that is, and it's not something that I would recommend that other people do. Mm-hmm. But with my personal account, I like to look for companies that have reasonable dividend yields and that also have a solid shareholder yield, which is when add the yield on the shares they're buying back to the dividend yield to get a combined total for the shareholder yield. Compare that to the free cash flow to make sure that they have free cash flow to support the shareholder yield so that they're not having to borrow to create it. And then within that universe of companies, I look for opportunities in the stocks where the stock has declined for either no observable rational reason or for something that's clearly identifiable where I think it's the reaction has been overdone. And then I like to buy those positions on weakness. And then I look for opportunities to maximize my annualized return. And what I mean by that is if I can, in my retirement accounts, my rollover IRA, 401k, whatever, yeah. If I can buy a stock with a 3% dividend yield and then sell it for a 2 or 3% gain within 5 days, that's a very attractive transaction. And that's sort of the mindset of what I'm looking to do. And part of what makes it possible is the fact that there's basically no transaction costs in the market these days. So it's not something that you could have done 20 years ago, but it is a strategy that you can employ today. And you also have the ability to be patient and wait because you've got a dividend yield that's paying you, and you've also got a stock buyback program that ought to limit further downside in the stock. But I'm always paying attention to what's my percentage gain and how long have I held it and how can I maximize it and go look for other trades that are very similar to that. And so, then the one other thing that I would mention is that I'm sure you guys are familiar with Michael Green of Simplify, sure, who's kind of the guru on passive investing and how passive investing is scrambling the markets. I find very weird things happen in the first 30 minutes of trading. And why might that be? Well, the fact of the matter is when ETFs get large inflows after the close of trading and before the open, or when they get large outflows in the same time period, they have to take action at the open. So I think you can see it at times in both indexes as well as individual stocks. The footprint of these ETFs that are doing their morning rebalancing because of large outflows and large inflows. And so I systematically screen for that and look for those opportunities.
So is it fair for me to say then, because why the disclaimer at the beginning when you say that I don't recommend people do it?
I was going to ask that same question, Bob.
Yeah, is it just more than, like, there's obviously more to the sauce? Like, are you doing a thing where you say, I make my gravy with tomatoes and garlic, and I don't suggest you do it at all?
No, it's because I feel as a fiduciary.
You feel responsible.
I feel as a fiduciary, I don't want to encourage people to overtrade. I don't want to encourage people to, don't try this at home.
Right.
Okay. In order to
I come from traditional money management, and as a good fiduciary, that's just not something I want to encourage people to do.
All right, I'm going to read our disclaimer then in order to take care of this. Okay, so this applies to what we've said so far and what he just said. Number one, nothing we say should be taken as financial advice or as a recommendation to do anything. Every opinion we express collectively or individually belongs to us and no one else, not to anyone sponsoring us, which is Mint Mobile, by the way, not anyone presenting us, producing us, or in a room with us, or appearing on one of our shows. They're ours alone. Number two, any figures or data we provide represent our past performances individually or collectively, which is never an indication of future results. On the data side, we use what we consider to be reputable sources. We cannot guarantee the validity of any data we represent here, and you should consider this part and parcel of your research and discuss anything we say with your financial advisor, personal advisor, or both before acting on anything we say. If you act on something we say, the responsibility for those results and those actions, positive or negative, are on you, not us. We will not accept responsibility. There's more.
I like that a lot.
There's more.
A lot more words, but that's what I was trying to say.
That's what we thought.
As we've mentioned many times in the past, we might be wrong, and we might also be idiots. That refers to Jim and I.
What I would encourage people to do is do your own research and look for investment opportunities, either to sell something that you own that's up way too much early in the morning, or potentially to buy more of something that you like already that's down way too much early in the morning, because there's a good chance that could be ETF inflows and outflows. That's basically informationless trading that's driving the price changes.
All right, do me a favor, repeat that one more time. And again, listen to the disclaimer as you write this down. Go ahead.
Yeah, it's just that what I would encourage people to do is be especially attentive to market trading in the first 30 minutes, because that's when ETFs do their rebalancing. So there may be stocks that you own that are fully priced that you were thinking about trimming. There might be some of those that go up quite a bit more than would make sense. And it's because of the unusual market volatility in the first 30 minutes of trading. And conversely, there may be a stock or two that you like and have been thinking about adding. Those stocks may go down, one or two of them, more than makes sense, or more than you would think given the market conditions at the time. And there's a good chance that an ETF or an ETF rebalancing might be behind that unusual market activity. And it's just something for people to be thinking about.
That makes sense. So when you look at your holdings, how often, how do I put this? Like, are different sectors appealing to you at different times when the macroeconomic story changes? Like, what are you looking at now for the remainder of 2024? What do you think should do well in the environment we're currently in?
Well, I mean, one set of stocks that has absolutely gotten trashed year to date would be the utility sector. And I don't have a strong opinion on interest rates one way or the other, other than, they have gone up, and that's partly why utilities have gone down so much. And one of the ways I try to look at it, I'm sure you guys are familiar with Tommy Thornton of Hedge Fund Telemetry and the way he uses DeMark analysis. DeMark Analytics or the RSI, or just thinking, just because utilities are down doesn't mean I want to buy them now. I want to wait for whatever some appropriate length of time is when it looks like they might be bottoming. And so I've been, bottom fishing in some of the utilities that have dividend yields over 4% that have gone down quite a bit in a month or a 5-week period. For whatever reason, 4 weeks, 5 weeks, 6 weeks seems to be kind of a decent mean reversion period, that once you get a sector that's gotten hammered for a period of 4 weeks, 5 weeks, or a month, that seems to be a good time when bottoms can be formed and you can start thinking about doing some bottom fishing. But again, a good dividend yield would be part of the theory there.
I spend a lot of time trying to get people to understand that I look at individual investors, and to me, they fall in two buckets. The guys who say, why do you want to buy energy now? It's getting crushed. And the guys who say, we got to buy energy now. It's getting crushed. What do you think an individual, who's not a CFA, didn't go to Wharton, doesn't have the floor experience that Jimmy and I have, what do you think is the best way for them to get started to be able to understand those two things? Is it top-down analysis? Is it financial balance sheets? What would you say to an individual saying, Gary, I need your help. I can't hire you. I can't afford you. You're way too expensive. What's the best way for me to get started to know when something's a buy and when's not? And I know that's a general question, but
that's a good general question. And I mean, there's some really good basic books that are available, either Amazon or lots of people providing basic seminars and information online or whatever. But using technical analysis as a common sense tool, to me, makes a lot of sense. But it would be in terms of looking for things that are bottoming, not chasing things, not buying things just because they're going up, or not buying things just because they're going down, but just trying to look at the market sensibly and pay attention to the valuation on things that you're buying and pay attention to the valuation on things that you're selling, and know what you own and know why you own it. But there's something to be said for common sense, actually. And I think that, Peter Lynch used to talk about, like, one up on Wall Street. Pay attention to the world that you live in, and trust your gut feeling and trust what makes sense. But don't go chasing super microcomputer just because it's gone up 13 days in a row and thinking that might mean it's going to go up a lot more in the 14th day.
Can I ask a quick question? Because this is something that's a source of embarrassment for me, because I know what you're talking about super microcomputers, but I've been really busy all the last week, and I was traveling, and I don't really remember what the story was. Why did it catch such an did NVIDIA mention them or something, or what happened?
They basically make servers with NVIDIA products.
Okay, and that's what caught on, and everybody had to get in.
That's what's caught on, and I mean, the business is booming.
And the same as ARM too. They do something with NVIDIA too, so they went through the roof.
The same with ARM, and I think the case with both ARM and super microcomputer is that the float is somewhat limited. I know it is with ARM. I'm not 100% that it's limited with super microcomputer. That's something to be checked. But obviously, when the float's limited, you get a much different dynamic in stock price appreciation.
Right. And I think maybe my not knowing the story is in some ways like subconsciously willful, in that once it's up 100%, up 150%, I'm not buying it. I'd rather just ignore it at that point in time. You know what I mean? Yep. If I thought I was breaking out of a pattern and I was there at the cusp of something happening, that'd be one thing, but not
with super micro specifically. Either on Thursday or Friday, the RSI was at a level that I guess RSI experts have only seen maybe one time previously in history. It was at 97, threatening to go to 98 or 99. I'm not sure where super microcomputer actually peaked. Wow. And then Tommy Thornton was also highlighting it, I think, on Thursday as having buyer's exhaustion and a DeMark analytical count of 9 or 13. I forget which it is. I rely on Tommy Thornton for the fine points.
Bobby, I have a question for you, and then Gary can answer second. Would you?
Diane Lane is my answer.
What's that? Who?
Diane Lane.
Oh yeah, that's a good answer. Diane Lane is a good anscer. Right, and by the way, she's probably about 58 years old now, right?
She's older than that. But I was just thinking to myself, somebody asked me, really off the subject, somebody said to me, name a male who's aged correctly and a female who's aged correctly. I'd pick Diane Lane and Merrill Hoge, who was a former fullback of the Pittsburgh Steelers and briefly with the Chicago Bears. But anyway, go ahead, Jimmy. What's your question?
That was off the anyway. The Magnificent Seven. Would you be touching these right now or no?
No,
not a
chance.
I just wouldn't. Right? Gary, you feel the same way, right?
Yeah.
Gary, my story. And I'm sure you saw me write about it on Twitter. This is about 2-3 months ago when Nancy Pelosi opened up her position in that one stock. I did too. It started as kind of a joke. I just wanted to be able to say that I bought a stock because Nancy Pelosi bought it. And then all of a sudden it's like 3 weeks into the trade. I'm like, Jesus, this is turning into real money. So I'm out of half of it right now. And I'd like to thank Nancy Pelosi because I do believe that's the first time a politician's ever done anything beneficial to me. She's not going to get my vote in any way, but I'd like to thank her. But yeah, NVIDIA, I'm not touching that at all. I mean, I'm probably going to get out soon.
Yeah, and as long as we're on the topic, obviously at the moment, if it's achieved Magnificent Seven status, NVIDIA is probably the hottest pony in the herd at the moment, and they report after the close on Wednesday. So that's going to be a huge event this week.
It's funny, we all were looking at FANGs 2 years ago.
Yeah, right.
Now we're looking at the Magnificent Seven, which a lot of the FANGs are not in. And I actually think it should have been FanMag, not FANG, because there was
Microsoft.
Facebook, Amazon, Netflix, Microsoft, Alphabet, and Google, or not Google, doesn't matter. But from that perspective, this is what I mean about like when people get fixated on this is the set of stocks you need to own because they outperform. And this is more of a question, Gary. Do people need to understand risk-adjusted returns as opposed to just returns? I feel like the entire market has lost the idea that the amount of risk you take matters. And I think, correct me if I'm wrong, it's why we're all saying right now that we wouldn't touch them.
Oh, I agree completely. And, if you, I haven't had a chance to listen to much of it, but David Einhorn of Greenlight Capital had a podcast interview last week or the week before last, where he was talking about how the valuation discounting mechanism of the stock market is basically broken. And you need to adjust for that in your investment strategy. And I think a big part of it has to do with 0 day to expiration options. And that's an innovation that encourages the worst aspects of human nature, I guess, is the way that I would put it. And that's all I will say about that, is that it just doesn't seem like a healthy product to have on the market.
Bobby, what do you think about that? I mean, I can't disagree. There's no way I can disagree. I can go back as recently as a decade and hear people talking about valuations and earnings per share. And I used to always watch the PEG ratio, right? That was something that I looked at very closely when I was looking at individual stocks, right? Price to earnings growth ratio. And these things are just out of the water. If you do a filter with a PEG now, very few stocks show up because the ratios are so out of whack. My old filters that I used to use, I can pull up a list of stocks and there's nothing on it.
No.
And
at the end of the day, the filters should have been, the broad market against the Fed's balance sheet, against the M2 money supply, against just liquidity measures to me. Because I think a lot of what would when you're talking about, what's the name of that SMI company that exploded?
Super microcomputers.
To me, that suggests that there's still extra liquidity bouncing around the system. And when you look at the stretch that's happened in the AI names, I think that underscores that as well. Could we just be talking about that the only thing that really matters is liquidity in the system, Gary?
It's certainly a big driver of things. I also like the way that Mike Green put it, because you can look at a lot of these extended periods where monetary liquidity correlates very closely with the S&P 500 performance. But then you'll also get these surprising 1 quarter, 2 quarter periods where it doesn't. And the way Michael Green put it, and I'll paraphrase it, I don't want to put words in his mouth, but he basically said that what we know is that monetary liquidity matters a lot, except sometimes it doesn't. And I think we all know, as experienced investors and traders, when you crawl the furthest out on the limb and you're a little bit leveraged and you're most exposed, that's the one time it's not going to matter.
Of course, right? Yes. That's
the perverse way the world works.
We always made up an option Greek. I think we called it epsilon, me and my partner, when we'd have positions on. And what it was just how little we know about how things are supposed to work and how our option is going to do the exact opposite of what we thought it was going to do. And we'll learn more tomorrow. But it was just a bullshit nonsense way to put it. But Bobby, what do you got?
Gary, if you had to pick 2 or 3 screeners, scanners, filters, what would they be now in this market? Like if somebody came to you and said, what do I need to look for before? Jimmy and I are both technical in nature. We get trade ideas and then we try to fine tune the charts for entries. Okay. So forgetting the technical side of it. Somebody said, I want to trade some individual stocks actively. Give me 2 or 3 things that they can put into their
2 or 3 like factors that you should look at.
Yeah, like PEG ratio, debt to equity, anything.
One that I would look at is free cash flow and the free cash flow yield. And there's 2 ways to do it. There's no reason not to do both ways. Yeah. One way is to look at the free cash flow yield as a percentage of the market capitalization of the equity. And then the other way to do it, which takes into account the debt on the balance sheet, look at the free cash flow yield divided by the enterprise value of the company, which is basically the market value of the equity plus the debt.
And where would you need those to be to say, okay, that's respectable?
It depends on a company.
Depends on the industry, right?
It depends on the company and the industry. Like if a company is growing rapidly and the business dynamics are positive, then 5% is a good number. But if you're in like one of the controversial sectors like energy, then you'd want the free cash flow yield to be a minimum of 7 or 8%. And you can find cases where 12, 13, 14% are reasonable. And then, like as David Einhorn was pointing out, if you want really large numbers, look at the coal stocks. The world's going to burn more coal this year than it did last year. And while coal is not a growth industry, we're going to be using more coal for a lot longer than anyone expects. And you can find some very high free cash flow yields in the coal and other neglected, hated sectors like that.
Do you mind sharing the names or symbols of those names that you think are attractive within that coal?
I'd rather not do that if that's okay.
That's perfectly fine. Yeah,
my overriding caution.
Yeah, I like that. Okay,
that's that old school caution. This guy.
The other, a couple other things that since you asked for, I pay attention to estimate revisions and earnings surprise, because that's a very good metric that will tell you how well is the business doing on a near-term basis. And when you're investing in companies based on valuation, whether it's a low PE ratio or a high free cash flow yield ratio, you're paying close attention to valuation. So you want to avoid value traps where the business conditions are deteriorating rapidly. And one way to avoid value traps is to look at estimate revisions and earnings surprise, where earnings estimate revisions are at least stable, if not rising. That's what you'd much prefer than estimate revisions that are absolutely collapsing at a rapid rate. The same thing with earnings surprise. You don't want companies that are severely missing the estimated earnings estimates of Wall Street analysts. And then just one other thing I'd throw out is pay attention to what the companies are doing with the cash. And again, I think shareholder yield is a good metric to pay attention to. And that's the combination of the dividend yield of the stock plus the buyback yield on the share repurchases that the company's using their free cash flow to buy in stock over time. Those are very good signs to look for.
Last question for both of you from me. Yes or no question. Actually, it's not a yes or no. It's an A or a B. Next 2 years, what matters more, Fed policy or earnings, Gary?
I think Fed policy and whether the deficit gets into crisis mode or not.
Jimmy?
Do I really have to answer? You know exactly what I think. When I brought this up to Larry Kudlow 20 years ago, we've been arguing about it ever since, where he was like, profits are the mother's milk of stocks. And I was like, bullshit. The mother's milk of stocks is Fed policy. The Fed is going to drive it. The Fed is going to drive it into the ground. Then it's going to drive it back up again. So
cheap and easy money.
Yeah. Well, thank you so much, Gary. Tell the people where they can find you.
You can find me online, basically on Twitter, at Gary Haubold.
Good.
And that's, I don't know what you guys think, but with very active selection of people to follow and close curation of my Twitter feed, it's the best investment tool that I've used in the last 20 years.
I think there's no question about it.
Yeah, I think you made a key point saying very carefully curated and selected.
Very careful.
Yes.
There's a guy named Kern. I can't remember his first name. Do you follow a guy named Kern who puts out stock charts? I think that guy's made me, and just, it's like very casual throwaway stuff. Like I just click up his chart and go, oh, that looks good. I'll buy that call spread. Boom, boom. And I think that guy's made me, enough to buy a house, and I don't even know him. I can't. Yeah.
And I'm not, and I know you guys aren't the kind of people that would ever follow any one person blindly or a group of people blindly. No. But it's great to have this continual flow of potential ideas flying past you all day long.
Amen.
Like, think about this. What about this? Could this possibly make sense? And it's just a wonderful way to have those kind of independent thoughts flowing by, oftentimes in graphical and visual form. And then you can go off and do your own work. It's just a great source of ideas.
Fantastic. Or in the case of Nancy Pelosi and Unusual Whales, they just post what Nancy Pelosi does. And if that's your thesis, just to piggyback, that works.
Isn't Unusual Whales amazing?
It's amazing. Yeah, I love that site.
That's a great service.
Yeah, I agree.
Gary is a great follow. You guys should all follow him. It's at Gary. Pronounce your last name for me.
Haubold.
Gary Haubold.
Gary Haubold.
Haubold at Gary Haubold. Make sure you guys follow him because he's a great follow.
And he not only does he add to the conversation, but he does so in a positive way. You know, so many people on Twitter can be dicks. Gary's never one of those people.
Yeah.
I do my best.
Thank you. Thank you very much. And
thanks so much for having me on. It was a lot of fun.
Pleasure. Thank you. We'll do it again.
Okay. All the best.
You too.
Take care.